One of the ultimate goals I've had for this channel is to make higher yielding investing a more mainstream strategy. Not just among retirees, but also people who might not be anywhere close to retiring. The allure of holding investments in stocks and funds that pay actual worthwhile distributions is something that I fell in love with while I was working at Vanguard many years ago. At the same time, because higher yielding investing isn't as mainstream as index funds, day trading, or investing in growth stocks, the information out there is still somewhat limited. And along the way, I've made plenty of mistakes or have just done things that I wish I would have taken into account before pursuing a higher yielding investing strategy. So in this video, I want to go over a few things that I wish I knew before pursuing the strategy that I have today. And all of these things aren't the usual cliches like avoiding the highest yielding stuff out there. The first thing I wish I knew before becoming an income investor is that to be successful at it, it does require a lot more discipline than I anticipated. On the surface, income investing seems like a pretty easy investing strategy. You buy into higher yielding stocks and funds and just watch the dividend payments snowball as you reinvest them or enjoy the income. It doesn't require you to watch CNBC every single day and monitor how the markets are doing. Rather, it's one of the most hands-off approaches to investing besides checking every once in a while to make sure that your companies are still performing as expected. But when you're just starting out, and even to a certain degree all of these years later, you still experience some market FOMO or fear of missing out. There's always at least a handful of hype stocks that the news outlets are raving about. These are companies whose stock share prices have grown by over 100% in a year or something ridiculous like that, and it's undeniable that this can be extremely appealing. If a stock share price has gone up every day for a week, it's easy to assume that if we invest some money in it today, it'll likely keep going up in share price. We've seen this with companies like Nvidia and Facebook, and a couple years before that, we saw it with Virgin Galactic and GameStop. It doesn't just happen within the tech sector either, as it does happen sometimes in the higher yielding stock sectors as well. Back in 2020, there was a weird situation going on with a company by the name of Power REIT, ticker PW. While basically every other stock in the market was tanking because of the pandemic, PW was soaring, sometimes as much as 45% in a single day. And unable to resist the temptation, I myself drank the Kool-Aid and decided to buy some shares of this company. I justified that since the stock was climbing so much in share price after all these months, if I just held some shares for a few days and then sold it, I would likely make a profit from the share price gains. Ultimately, and fortunately, it did work out for me and I sold my shares for a higher price, but doing so felt more like gambling in a casino than actually being an investor. And sure enough, in 2022, the share price of PW collapsed by over 94% that year. Had I decided to press my luck and let greed take over, I could have lost a ton of money on this. Pretty much all of the most successful stock investors in the world, including Warren Buffett, regularly stress the importance of having discipline when investing in the stock market. Trying to get short-term gains on high-risk companies is one of the worst ways you can possibly invest. Ultimately, I now resist the temptation and I no longer invest like this anymore. It's really important that you don't chase the most popular hype stocks because they all have the same thing in common. All of them do eventually crash, and if you happen to be holding on to them when they do, it could set you back years financially depending on how much money you put into it. There isn't anybody out there who can perfectly time the market, so it's just better to put your money into consistent high-paying dividend stocks that'll generate cash for you. The second thing I wish I knew before becoming an income investor is that it does require a lot more specialized knowledge to be good at picking investments. The biggest income-paying stocks are usually REITs, BDCs, MLPs, and these other unique asset classes, which are actually considered to be alternative assets by financial institutions. These kinds of companies can actually sometimes come with their own unique financial metrics, standards, and sometimes entirely different financial statements. With that being said, you can't analyze these companies the same way you would if you were looking at a regular dividend-paying stock. Those stock websites that give their own ratings to investments based upon their financials are almost always useless when it comes to these alternative assets. That's because Seeking Alpha, TipRanks, and all these other platforms will use the same system to analyze both a BDC and a car manufacturer, and based upon their system, tell you if a stock is a buy or a sell. But obviously these two companies, a BDC and a car manufacturer, are going to report financial results in a completely different way, so it's likely not going to be very accurate for an alternative asset. I still use these websites to do things like look at financial statements or read the news, but I don't rely on a stock's rating website to look at a BDC, a REIT, a closed-end fund, or any of these assets. For the time being, you oftentimes have to just dig through the metrics and the financial statements yourself to see how well one of these assets are doing. On the plus side, it is a good way to know if the person who's analyzing one of these alternative assets actually knows what they're talking about and if you can rely on their judgment.
Boring REIT. Oh boy. Bang REITs.
Realty Income Corp. Real estate investment trust that invests in freestanding single-tenant commercial properties in U.S., Puerto Rico, and UK. Let's look at them. Market cap of $22.5 billion. PE of 57x. Profit margin of 24%. Check mark. Free cash flow last year, $1.1 billion, which is surprising considering where the economy went. And a 5-year average of 943. So it seems pretty consistent.
You don't look at the PE ratio or the gross margin when analyzing REITs. They're basically useless for these companies since they own and rent out real estate. Unfortunately, the number of resources out there when it comes to learning how to analyze these investments is still lacking in my opinion, and so to get good at actually analyzing these companies simply involves just putting in the time to do things like read financial statements, listen to their shareholder meetings, explore the investor resources on their website, find articles or financial websites, and so on. Finally, one more thing I wish I was aware of before becoming an income investor is just the nature of cycles. What I mean by that is, because we invest in these very specific kinds of investments, we tend to be less diversified and our holdings span only a handful of sectors. A large chunk of an income investor's typical portfolio is likely made up mostly of real estate, BDCs, and bonds held in closed-end funds. We don't usually hold tech stocks, food companies, gold, cryptocurrency, pharmaceuticals, and so forth. Our holdings don't cross over into too many different sectors, and as a result, when things slow down or just go bad, we can be in the red for a long time with our investments. When interest rates were increased over 2 years ago, I will admit that I underestimated the impact it would have on so many of the higher yielding investments in my portfolio. And as a result, many of the REITs, especially as of last week, are still in the red. For example, some of my larger purchases into Realty Income are still down, and they've been that way for years now. I know that I've said over and over again that we invest for dividend payments and not share price, and Realty Income continues to grow in all the right areas, including their real estate holdings and their funds from operation, so I have no doubt that O will soar to new heights eventually. But I can't deny that seeing a loss on my investment from a share price perspective can still be hard to look at sometimes in my brokerage account. When the Fed started increasing interest rates over 2 years ago, I was not under the impression that they would remain this high for this long. I was opting to be more optimistic in that they'd find a way to resolve this inflation problem, but it's been taking a lot longer than expected. On the other hand, while interest rates have remained high, my business development company holdings have been doing extremely well as they often flourish in high interest rate environments. With the most recent data that just came out last week, although I do think it's unlikely, some people have been speculating that interest rates could potentially remain high for a very long time. And if that is the case, then my largest investments will likely remain down for a long time as well. That's not pleasant to think about, but this is another area where discipline is absolutely crucial. The exact same thing can happen to oil and energy companies. I hold oil companies, and these sectors are also very cyclical, and someday we could see all of these stocks temporarily fall for a long time as well. So it's important to keep in mind just how harsh things can actually be when sectors are down. It makes me wish I had even more money to invest right now while the market remains pessimistic towards REITs. And I know that the whole market in general was down for a long time following the financial crisis back in 2008. This isn't something that's unique to income investments. But it's just especially relevant for us right now because other sectors are still flourishing right now. But that's going to wrap up 3 things that I wish I knew before becoming an income investor. Despite all of these things, I just want to say that I still have no regrets whatsoever about choosing this investment style. I would still do it if I had to start from zero all over again, as I still love the dividend payments that I get. Let me know if anything caught you off guard when you started becoming an income investor yourself and what that was like. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.